So we can consider some single period, or we can consider all future dividends, and discounting them, you can calculate the value. So these are the things actually we discussed last week. So now we start with dividend discount model. Based on the expected dividend and based on expected selling price, we can calculate present value. Let's start with the first single holding period method. Right, single holding period method. I think this is the slide we have to start now. Yeah, from the single holding period method. Anyway, I will record the lecture. It's recording. Huh? It's recording. All right. Okay. Right. So we can start with the dividend single holding period. When it's come to the single holding period, in this model, field side. Right. So now, anyway, so we can see value of the ordinary shares we can calculate basically based on these two scenarios, considering next period dividend as well as next period expected price. So in the first one, so you can identify some expected price if you are investing for a certain period. If you invested for a certain period, you may have an expected selling price. Because when it comes to the equity shares or the ordinary shares, no maturity. There's no maturity. So therefore, you are investing for a horizon, some period. So we call that your investment period or the investment horizon. So considering that, you can value the stock under the first bullet. So you have to consider next period dividend as well as expected stock selling price. Second one, discount present value of all future dividend payments. So here we consider all future dividends of the ordinary shares, because for the ordinary shares no maturity. So we have to consider dividends based on the expected dividends. You have to calculate the value. So we are considering these two paradigms or two scenarios when we calculate the intrinsic value for the equity shares. So you can see that I think it's explaining value or the current price depends on expected dividend and expected price. So if you are investing for a certain period, you have to identify your expected dividends and the expected price. So discounting these expected dividends and expected selling price by your required rate of return, that is the discount factor, you can calculate the value, right? So normally when you calculate in the intrinsic value, you should know your required rate of return. I think you remember when bond valuation, when we discussed the bond valuation, the discount factor was bondholders' required rate of return. Now ordinary share valuation, equity share valuation. So now it is equity shareholders' required rate of return. Right? So required rate of return for the equity shareholders, required rate of return for the equity shareholders, this is the required rate of return for the bondholders. Are they same? This is the discounting factor. When you are calculating the intrinsic value, this is our discount factor. Using the required rate of return, you discount expected dividend to the present, expected selling price to the present. So that total is the intrinsic value. Are they same? No. Why? Risk, because of the risk. Normally, risk for the equity shareholders compared to the bondholders or the debt capital providers is high. So therefore, their required rate of return should be greater than the required rate of return for the bondholders. I think I explained this thing. So now we can calculate bond intrinsic value. Value of a share today depends on cash inflows expected by investors and the risk associated with these cash flows. So, in order to calculate the value, you know our very fundamental model of the value calculation, because now we have completed time value of money, bond valuation. So you know this. So value depends on expected cash flow and risk associated with this cash flow. So that risk implied here in the required rate of return. So you can calculate value, expected cash flow, you are discounting using this required rate of return. So this required rate of return includes risk-free rate plus risk premium. So risk, premium for the time value, premium for the risk, are incorporated in this required rate of return. Our next lesson, risk and return. So under that risk and return, we are going to estimate this risk premium for the ordinary share for the equity investment. Right. So value depends on expected cash flow and the risk associated with those cash flows. Cash inflows expected from ordinary shares plus the capital gain. So if you invested equity or the ordinary shares, you know you expect a return. You can have some dividends and capital gains, no interest, right? If you invested the equity shares of a company, what are the expected returns? Dividends and capital gains. These are the expected returns. The value of ordinary share is determined by capitalizing the future dividends stream at the opportunity cost of capital. Or this is your required rate of return. This is our relevant cost discount factor. So you should know this discount factor as well as expected cash flow to calculate this value. In practice, there could be difference between present value and market value. I think I explained this thing. In practice, in the real world, there is a difference between market value. This is value, intrinsic value. There might have some differences between the market price or the trading price and this value. Yes, because market may be inefficient, might have some imperfection. So if the market is not perfectly informationally efficient, then market price is different from the value. There can be. But if market is efficient, if all the information related to particular company's stock, if they have incorporated in the stock market, if they have incorporated in the stock price, so then market is efficient. So informationally market is efficient. So at that time we can say market value or the trading price is equal to value. In an efficient market, market price, trading price is equal to value. But if market is not efficient, undervaluation, overvaluation can be there, right? In practice, there could be difference between present value. Present value means this value, intrinsic value, and the market value, trading price, market price. Based on this, investor can make decision whether buy or sell. We have discussed this thing. Normally, when you are taking the buy decision, normally as an investor, when you buy, market is yes, normally buy when market is undervalue or overvalue. Undervalue. If market price less than the value, intrinsic value, so that means there is underpricing, undervaluation of that particular company, so you will buy. Normally you are taking the investment. By mean you are investing. So you may sell if you are already investor of that particular company. If market is overvalued means market price is greater than the intrinsic value. So that is the overvaluation. So when the overvaluation is happened, normally you sell. Normally you are not investing when the market is overvalued. when there is overvaluation. Right, so you have to take this decision either to buy or sell based on this situation. I think under the bond valuation we take this decision. So same you can apply for the here ordinary shares also. Right. So now we are going to calculate the value. So first we'll discuss single holding period model. Single holding period method or model means so we calculate value, right? We calculate value from the investor's perspective, right? Here we are calculation from the investor's perspective. So single period, single holding period means investor invest ordinary shares in ordinary shares for a particular period. That period can be 1 week, 1 day, 1 month, 1 year, or whatever duration. Single period, during this single period, investor receive dividend. At the end of the holding period, he expect to sell shares at the price, at the expected selling price. So two things can happen in the single holding period method. This is one what we call one scenario or one method to calculate the value. Because for the equity share valuation we have to consider different methods. Now this is based on this first bullet. This one. Discounted present value of the next dividend payment and next next period stock price. So under the single holding period, you may hold shares of the company for particular period. Period can be any duration. Even 1 day is a single period. So during this period, you are getting some dividend and you may sell shares at the end of the period at an anticipated selling price. So these are the two things can happen during single holding period. This is applicable when an investor holds stock only for one period. So this one period, any duration. We call it as a one period. So therefore always here 1 plus r into the power 1. N is always equal to 1. In single holding period method, N equal to 1. One period after which he would sell the stock to another party. So this is single holding period. So you can see formula, nothing new. Now we have did the time value of money. You can see DIB1. So that is dividend in the next period. So today you invest Sampath Bank PLC. You are planning to hold this investment for say 1 month. So that is your single holding period. So you expect during this 1 month some expectation for the dividend, say 3 rupees as the dividend. And also at the end of the 1 month, you are going to sell based on your analysis, you might have some anticipated selling price. So DIV1 means you expected next period dividend. So P1 is price of the stock in the next period. So during this period, you may receive dividend. At the end of the period, you are going to sell. So if that is your expectation, so that if you are investing in that nature, so this is the model to calculate intrinsic value. This is one method, one scenario. So then you have to discount expected dividend and expected price to the present. So that is the value. So here R, you can see R here required rate of return for common stock or the common shareholders, equity shares. The value equals the price when markets are efficient. You know that. So let's look at the example. This is related to the single holding period method. Expo PLC expects to pay dividend of 15 rupees at the end of year 1, and the expected price of the stock is 355 at the end of year 1. If required rate of return for the stock is 12% per annum, what is the intrinsic value? What is the value of the stock? So now this is not a multiple holding period, so the given information related to the single holding period. So you have to apply that model. So value you can calculate, value of the Expo PLC shares is equal next period dividend expected to have 15 rupees. And at the end of the year 1, you expect price of the stock to be 355. So you have to discount this cash flows using your required rate of return 1.112 into the power 1. Here n is always equal to 1 because it is a single period plus 1.112 into the power 1. So this is the value. Right. So then you, what is the value? 300, 30, 330.6. So if you are going to invest Expo PLC today, this is the maximum. This is the maximum you wish to pay. Suppose that in current market, in the current stock market, Expo PLC shares trading for 335. Company shares currently trading at 335. So then, are you investing? What is the decision? Invest or not? Huh? This is the intrinsic value. Fundamentally, value should be according to the fundamentals. This is the trading price, 335. So what is happening in the market is a overvaluation because this is the price should be. So you can see market trading price is greater than the intrinsic value. So therefore this is the overvaluation situation. So you might not invest when stocks or when shares are overvalued. Okay. Right. So your answer is 330.36. Right. So this is single holding period method. Multiple period method or multiple period. So you are holding shares for more than one period. Multiple. So you can see the formula. So during this multiple period, say 5 years, 6 months, or likewise different periods are there. So you are getting dividends in different times, not one dividend. So therefore you have to consider, now if you look at this formula, you can see you have to consider expected dividend at the end of each period separately, calculate the present value of dividends, discounting by your required rate of return, then expected selling price at the end of the period, you have to discount it back to the present. If it is a multiple holding period, each dividend you have to discount it to the present and get the total selling price at the end of the period, discount for the particular period relevant, then get the total. If it is a multiple holding period, so you have to consider expected cash flows, basically dividends and the price. like this. Now, if you look at this example, investor is looking for a 4-year investment. Now, this is not single period, 4-year investment. The CTH shares is selling for ₹75. They have plans to pay dividends of ₹750 per share at the end of first and second years, and ₹9 and ₹15 respectively at the end of third and fourth years. If required rate of return on this investment is 12% and the share price at the end of the fourth year is ₹70, what is the value of the share today? Now, this is not a single holding period. This is multiple period method. So you have to consider all these cash flows. So you can now there is if you draw the timeline for this, it likes this 4 years now. So you can see 4 years. Currently, the company share is selling for ₹75. So they plans to dividend ₹750 at the end of first and second years. So you may expect ₹750 here, also ₹750 at the end of first and second years, and ₹9 and 15, 9 and 15 respectively at the end of third and fourth years. Required rate of return is 12% and share price at the end of fourth year expected to be ₹70. So what is the value? So you can calculate value. You may discount these expected dividends. So the expected selling price here ₹70 at the end of fourth year. So discount them back to the present. This is you have to discount for 1 year. This ₹750 you have to discount it for 2 years by 12%. This ₹9 you have to discount it for 3 years to get the present value. So here dividend is ₹15, expected selling price 70. Both you have to discount it back for 4 years. So get the total of this. This is the value. This is we call multiple holding method. What is the value? What is that? 78.58. 78.58. You can check the value here, 78.58. Correct? I didn't calculate. You may check it. 78.58 or how about others? Can't have the two answers. What is 71? 73. 73. I think most are getting that. So my 73. So 73 is the value. So now, what is the decision? Are you investing CPH company? You are not investing. Are you investing? No. Sure. Huh? Sure. 73 is the intrinsic value. Yes. 75 is market trading price. So more than the intrinsic value. So in market that is overvaluation. Right. Good. You have confidence. Good. That you are balancing on it. Right. So next one is zero growth model. So now actually this based on the dividends and the expected selling price, value calculation is over. If you are investing for a certain period, so you can calculate by considering expected dividends and the expected selling price. But normally for the ordinary shares, no maturity. So they are exist as far as the company is doing their function. So therefore now here we consider future dividends. So based on the future dividends, now we are going to calculate the intrinsic value. So under this dividends, expected dividend, future dividends, so we first consider zero growth model. Zero growth model means, so this can happen, occur when dividend payments of the company expected to remain unchanged. Company is paying dividends every year, but no growth. So that is sometimes when a companies become matured or they are in a growth stage in their life cycle. So sometimes companies maintaining constant dividend. Every year they are paying 5 rupees for a long period without growth in dividend. So that can happen. If there is a dividend without growth, we call zero growth. So then you can apply zero growth model to calculate the intrinsic value. Different methods, different models. Here we apply different models because of the uncertainty of the expected dividends under the ordinary shares. So under the zero growth, you can see value of the stock you can calculate just dividend divided by required rate of return. So you can see, you can remember under the time value of money we discussed when there is annuity, perpetual type annuity, perpetuity. Under the annuities we discussed perpetuity. When you are receiving a constant or the annuity for a long period, so you can calculate value simply cash flow divided by discount factor. So that model we apply here under the zero growth dividend discounting model. So simply you can calculate value dividend payment, dividend per share divided by required rate of return. That is the model. Suppose Coco PLC has just paid. Coco PLC has just paid a dividend 6 rupees for last year and expects to maintain same dividend payment throughout the coming periods. අපිට පේන තෙක්මානික මේ dividend එක company එක ගෙවයි කියලා හිතෙනවා. So that is the phenomenon. That is the name. They are paying 5 rupees, 6 rupees. So we believe, we have some expectation, the company will maintain same dividend for a long period. Because they are stable, their earnings is stable, so they can pay that dividend without disturbance. So we expect as an investor, so they will pay this 6 rupees for a long period. If required rate of return for the Coco PLC investors is 12%, what is the value? What is the value? Yes.
What happens if the company doesn't pay dividend and the company pays everything not others? Then
No dividends. Yes, there can be some periods, no dividend. After certain period, there might have dividends. So, kind of fluctuations can be there. Under the differential growth rate, we have discussed that kind of situation. Normally, price is not given by the company. Price is created in the marketplace based on the demand and supply. Right? Based on the price, investors can have a capital gain. Price will be determined by the market, by the marketplace. When a company is performing well, I think in the introduction I explained you how this price is affected by the company's operations. When the company is performing well, when they have a good profit, when they have a good investment, when they are doing their activities in an effective way, so then demand for this particular company is increasing. So when the demand is increasing, market price is going up. When the price is increasing, investors will get what? With the price appreciation, with the price increasing, what is the return investors can have? What is the return? When the price is going over, when the price is increasing, what is the return that investors can get? Capital gains. They can have a capital gain. If they need, they can sell the shares to get this capital gain, capital return. Or they can keep in their investment for another period. For the ordinary shares, no maturity. Ordinary shares are the maturity than that. When the company's share price is increasing, if I have Sampath Bank PLC shares, so I can see that market price is increasing. Maybe because of some positive reason. So as an investor, I can decide if I try to get the capital gains, so then I will sell and I will get my capital gains. Or I can keep them for another period with the expectation of having more capital gains. If prices increase further, so I can have a large amount of capital gains. So that depends. That depends on the company performance. Every year, company is not paying dividend. Okay?
Company doesn't pay dividend and company pays kind of related to the inflation.
I didn't get your question. Company didn't pay any dividend. Yes. When company is not paying dividends, you can learn under the dividend policy. There is our one lesson here. Dividends have signaling effect. Signaling effect. When a company is paying dividends, according to that signaling effect theory, it says that it goes positive signal to the market when a company is paying dividend. And also there is another argument, when a company is paying dividend, it provides a negative signal lever. So it implies that company does not have many investment. When they are paying high dividend, it means that they are not retaining much more. They are paying their profit as the dividends to the shareholders. It implies that the company doesn't have investment. So sometimes in the long run, when a company is paying more dividends, right, not in the short run, when a company is paying more dividends, it goes as a bad negative signal to the market. So then we perceive that particular company as a company, in the long run, they will outperform because they are not doing good investment. So then at that situation, in the long run, company market price of the company shares can be decreased. Immediately with the dividends, then market price of the shares can increase. So that effect is different. Long run effect is there, short run effect is there. It depends. It depends. You have to analyze. Huh?
The cash flow, the cash will be inside the company.
Yeah, when a company is not paying much dividend, it means that two things are there. No enough profit. They are not earning a strong profit to pay the dividends. Their profit is very, it's not strength, and that's a poor profit. That is also implied. When company is not paying, another implication, another indication is there. Company keeping their profit for the reinvestment. Right? When the payout is decreasing, on the other side, retention is increasing. Retention ratio is increasing. So it implies that they are using profit for the reinvestment. Right? So these are very interrelated. Right? So these are very interrelated. So dividends is a puzzle. Dividends is really a puzzle. Because sometimes dividends gives good impact. And also sometimes it's act as a bad signal. So likewise, even if you read the literature related to this dividends related studies, still dividend is a puzzle. Dividend related happenings is a puzzle. But anyway, your point, I think we consider under the differential growth rate. When company is not paying dividend, the market price may not increase. So then investors may not receive in proper much capital gains. Right? All these things are affecting with the company operations, happenings, investment, decisions, long-term investment, everything are affecting for this kind of thing. अभी मैं निकाल simple model का पता कराना, this is very complicated, very complex things. Right? All these dividends, retention, growth rate, market price, all are related. Isolatedly, you cannot discuss anything. When market price is increasing, that is the main, what we call a symptom. Okay? Market price is increasing. So what is the causes behind this? When the market price is increasing, you have to analyze what is the reason for this increasing. Reasons from the company inside reason can be there, internal reasons, and also economical reason can be there. So you have to analyze. When the market price is going down, that is the symptom. So what is the reasons for this symptom? So these are behind the company happenings. Annual reports. You have to look at the past data. You have to analyze. So these are kind of a complicated thing. Okay, good. Question I appreciate it. Right. So we go on the zero growth model. So what is the answer here? This is zero growth. What is the answer? 6 divided by 12. So value is 50 rupees. Value is 50 rupees. So if you are going to invest, this is the maximum you are willing to pay. Constant growth model. Next one. We call Gordon model. Some textbooks they use Gordon because this model is founded by a person called Gordon. So therefore, sometimes we refer it as a Gordon model. G-O-R-D-E-N. Gordon. So what is this? Under the constant growth model, dividends could grow at a constant rate when the earnings growth and the payout policy of a firm are expected to remain unchanged. Right? When company earnings growth is constant, and also if company payout policy is constant, right? You can expect constant growth in dividends. You can look at past data. You can analyze dividend per share information for the company past 10 years, 15 years, 20 years life. So you can see the payout policy, payout ratios you can calculate. And also you can analyze earnings or the net income of the company. You can calculate the growth of the earnings, right? So when you can see there is a constant growth in earnings as well as a constant growth in payout, You know what is payout? From the earnings. If they earn 100 rupees, from this 100, they are doing two things. Paying as dividend and retaining. We call this is payout policy. This is retention ratio. Payout ratio and the retention ratio. If the payout is constant and company earnings is constant, so then you can expect this company dividends growing at a constant rate. So normally when for the companies there is a life cycle, development, rapid growth, maturity, so stabilizing. So likewise they are reaching to stabilize, so the statutory point in their life cycle after 10 years like operation, 5 to 10 years operation. In the stabilized or the matured period, companies can increase their dividends at a constant rate because their earnings growth is constant. So they are doing payout also at a constant rate. So therefore, in such a situation, if a company in such a period in the life cycle, so then you can apply constant growth model to calculate the value, to calculate the intrinsic value. Dividends would grow at a constant rate. So dividends is every year or every quarter, every year increasing at 10%. So that is a constant growth. Zero means no growth. Every year 5 rupees. That is zero growth. Growth is zero. Now here, company paid dividends. Dividends are increasing at a constant rate. When the earnings growth and the payout policy of the firm is constant. So you can apply this constant growth model to calculate the intrinsic value or the value of the share. So this is the another model to calculate the value of the equity share. So value according to the constant growth model is equal D1, DIV1 or D1. What is the D1? You can see this definition is very important when we are applying the differential growth model also with the constant period. So you should be able to define this one accurately. D1 or the dividend next period. So how to define that? Dividend payment immediately after the start of the constant growth. Dividend payment immediately after the start of the constant growth. So here you have to take D1. If I explain further, suppose like this is a timeline, say 0, 1, 2, likewise. Suppose that company has paid here 3 rupees, 350, 3, 4, 5. So likewise, company like this going ahead. Suppose this company, after the 2 years of this dividend payment, they are maintaining constant growth in dividend after year 2. Right? They have paid dividend like this 320 different dividends. After year 2, they are maintaining constant growth in dividend for the indefinite period for a future. Right? So then to calculate the value of the shares to the, say here at the year 2, if you are valuing these shares to the year 2 in the timeline, so you have to consider D3. When you apply the constant growth model, you have to consider D3. Next period dividend. Dividend payment immediately after the start of the constant growth. So constant growth is starting from the year 2. Then immediately after the start of the dividend is the next period dividend. So when you apply the constant growth model to here, you have to consider, you have to take D3. So that is the meaning. In next differential growth model also we apply this one. Don't worry about that. But anyway, this definition you have to take into mind. D1, DEIB1, dividend payment immediately after the start of the constant growth. Others I think know this one. G. What is the G? Constant growth rate of dividends. Now dividends are growing at a constant growth. So that G is the constant growth of dividend. So then you can apply R is our required rate of return. Value is the intrinsic value or the present value. So you can apply constant growth model to calculate the value. Constant growth model is most appropriate for mature companies with stable history of growth. Normally, according to the literature, empirical literature, it says that after the 10 years of establish of a particular company, so you can apply this constant growth model to calculate the value. For the matured or the stabilized company, you can apply this constant growth model to calculate the intrinsic value. Because we assume that matured companies are paying dividends at a constant growth. They are increasing dividend at a constant growth. This is another paradigm, another scenario, right? So we discussed single holding period, multiple holding period, zero growth, now constant growth. Okay? Look at the example. Before going to this thing, just look at this example. Constant growth stock. So you can see further to the earnings growth, payout policy constant assumption. You can see other assumptions, or these assumptions are also valid when you apply the constant growth model to calculate the value. Following condition must follow. Model assumes that dividends paid by the company will grow at a constant rate. So that is why we call it as a constant growth of dividend. Stock price will also grow at the same rate. So with the earnings growth is constant, payout policy is constant, then dividend growth is constant. So we expect that stock price also increasing at same pace. This is implied. Expected dividend yield is constant. Yes, because dividend growth rate is constant. Price also increasing at the same rate. So then dividend yield also constant. Dividend yield means dividend yield you can calculate dividend per share divided by market price. So then your dividend yield also a constant when you are applying the constant growth model. Expected capital gains yield also constant. Yes, according to this model, we assume that price in the market is increasing at the same rate. Same growth rate එකක price එකක් වැඩි වෙනවා. ඒකට එහෙමනම් capital gain yield also constant. Expected total return, dividend yield, capital gain yield. Total return means dividend yield plus capital gain yield. So expected total return is equal to expected dividend yield plus expected growth rate. So that is also increasing at the same pace. So these are some underlying assumptions when you apply the constant growth model. So that is why we mentioned in the previous slide, this model you can apply for a mature companies, not at the early stage, not at the companies in the introduction or the development stage. When a company in the matured level, in the when they have a considerable history, past data, happenings, when they approach to the maturity, you can apply this constant growth model. Strength and limitation. Strengths you can see simple, applicable to stable, mature firm. Growth rate can be estimated using the company data. Yes, we are going to estimate the growth rate using the retention model, dividend retention model. So by looking at the past data, past dividend behavior, you can estimate the growth rate. Limitation. Not applicable to non-dividend paying firms. If company is not paying dividends, we cannot apply constant growth model. Growth rate must be constant. So we assume that growth rate is constant, but anyway, sometimes it is unrealistic because normally dividends are fluctuating. For the equity shares, dividends is changing, depends on the director board decision, available investment, requirement of the funds. So likewise, these factors are affecting. So assuming the constant growth rate in dividend might unrealistic. So that is a limitation. Stock value is very sensitive to this difference, required rate of return and the growth rate. So that is a limitation. So value is depends on this difference. So that is sometimes some textbooks argue this as an unrealistic assumption. Most firms have 1% growth in dividends. So normally companies pay different dividends. Depends on the certain factors. So these are some limitations and also the strength. But anyway, you can apply constant growth model also to calculate the value. Right. Let's look at this example. Here has just paid dividend of 7 rupees for last year. Right? Just paid. You can see just paid a dividend of 7 rupees for last year and expects to increase the dividend payment by 5% each year. If the return required by investors for this company is 10% per annum, so determine the present value of this common stock. So with this given information, you cannot apply zero growth, single holding period, multiple holding period. So the relevant appropriate model is constant growth model. So according to the constant growth model, value of the equity share, so the value of the equity is equal next period dividend divided by required rate of return minus constant growth rate. So then how much the just paid dividend of 7 rupees. So is it D1 or D0? Just paid, already paid. So that is D0, right? So you are given here 7 is the D0. D0 is equal 7 rupees. That is already paid, recently paid, just paid dividend. So then you have to calculate D1. Next period dividend you have to calculate. So next period dividend is equal, this 7 rupees should increase by 5%. Because dividend payment are expected to increase by 5% each year for future. So then D1 is equal 7 into 1.05. Dividend 7 should increase by 5%. So then value of the stock is equal how much the D1? 7.35. 7.35 divided by required rate of return 10% minus constant growth rate. So you will get the value 147. So this is the application of the constant growth model. So you can apply this constant growth model when there is a constant growth in earnings as well as their payout policy is constant. So then you can apply this constant growth model to calculate the value of the ordinary shares. Right. So the next one is the last model, differential growth model. So normally in the reality, companies are maintaining different growth rates, right? Different growth rates. At early stage in their life cycle, sometimes they may not pay any dividend. When the companies mature, becoming matured, so they are paying high rate. When they are stabilized, company maintaining constant growth for a long period. So kind of things you can see in the reality. Consider the situation where there are multiple growth of dividends. Multiple growth, right? Supernormal growth, lower rate, high rate, constant rate. So likewise a combination of the different growth rates. So that is the real practically happening. So look at this example. I think this is not clear. Don't worry about this formula. We can discuss the question and then we can calculate after. Finally, we'll look at the formula. Look at this example. JKH PLC forecast the following growth rates of dividend. Company has forecast, or the investors of this company has forecast following growth rates of dividend. Company expects the dividends to grow at a rapid rate of 15% until end of year 2, after which dividends will grow at a rate of 10% for 2 years, after which it will stabilize to long-run constant growth of 5%. Right? So, after analyzing the company history, annual reports, investors have identified expected dividends for this company like this. For the next 2 years, they expect rapid rate for the dividends at 15% until the end of year 2. After which it will grow, the dividends will grow at rate of 10% for 2 years, another 2 years. Then they are stabilizing to a constant growth of 5% for a long period. If recently paid dividend is 7 rupees per share of this company, determine the present value or the intrinsic value of this common stock or the equity shares of the JKH PLC. Assuming required rate of return for the investors is 12% annually. Now the different rate, right? So this is more close to a practical or the in the practice what is happening. Different rates are there. Not zero growth, not constant growth. So this is the nature. If you are going to invest certain period, so you can value by considering the long period of the company, because we assume that companies has a going concern. They are surviving for a long period. Okay? There is some concept of going concern, so we assume that they are living or they are doing their operations for a long period, regular long period. Right. So now, before doing this, now draw the timeline for this. We can, without looking at the formula, we can do it simply. Now draw the timeline and just calculate the dividends. Right, you can first so this is right? 0. The company expects dividends to grow at a rapid rate of 15% until the end of year 2. Say 1, 2, 3, 4, 5. So likewise. So first 2 years until year 2, the company expects the applicable dividend growth rate is 15%. End of year 2. Then after which dividends will grow at a rate of 10% for 2 years. So then year 3 and year 4 dividends growth rate is expected to be 10%. After which it will stabilize to long run constant growth of 5%. After the year 4, this company is expected to maintain long run constant growth of dividend at 5%. So this is the prediction. Recently or the just paid company just paid dividend is 7 rupees. So we can say D0 is 7 rupees. Now identify the expected dividend in year 1, year 2, year 3, year 4. So 5, likewise you can do that one. Based on the information, calculate the dividend expected for the 4 years, 5 years. From 0 to year 1, dividends is growing at 15%. So D1 is how much? D1 you can calculate. So D0 7 rupees should increase by how much? 15%. So therefore you can identify D1 is 7 rupees should increase by 1.15. How much the D1? 8.05. So likewise D2 from year 1 to year 2 again this D2 you can calculate. D1 should increase by 15% again. From year 1 to year 2, it's expected to growth of dividends 15 rate is 15%. So this also should increase by 15%. So D2 9.26. 9.26. D3 D2 is 9.26. After year 2, for the year 3 and 4, dividend will grow at a rate of 10%. Question it says. So then D3, from year 2 to year 3, dividend should increase by 10%. So then 9.26 should increase by 10%. 10.19. D3 is 10.19. D4 also 10%. 3 to 4 10%. So then D4 you can calculate 10.19 should increase by 10%. 11.21. Right. So these are the expected dividend. Right. Now, after year 4, after year 4, it says that it will stabilize to long run constant growth of 5%. After year 4, from here, the company is going to stabilize into a long run constant growth of dividends at 5%. Within a company like a Digu for an indefinite period, they are maintaining 5% growth in dividends for a long period. So now, what you have to do when company is maintaining long-run stabilized constant growth of 5% for a long period, now you have to value these shares to the point where the constant growth is started. Now, in this example, constant growth of dividend is starting in year 4. From year 4 to onwards, for the future, company maintain 5% constant growth of dividend. So then, by considering all these expected dividends in the future, you have to value these shares to the point where this constant growth is started. Right? By considering now for a future, for an indefinite period, for infinity, අපි දන්නේ කොච්චර කාලයක්ද කියලා. කම්පැනි එක 105කින් හැමදාම ලාභාංශ වැඩි කරගෙන යනවා. For a long period. Right? If so, then what you have to do, by considering all these expected dividends in the future, you have to value these shares to the point where constant growth is started. Now in this example, constant growth of dividend is starting at the end of year 4. From year 4 to onwards, there is a constant growth of dividend. So to the year 4, now you have to value the share. Either return value එක කියලා මොකක්ද? return තමයි ගන්න value එක. You will value the shares to the end of year 4. What is it implies? The value is present value or the value of all expected dividends to the point or to the year 4. Okay. Constant period के केवल सिरुम लाभांशवල මෙතනට value. That is the meaning. So you are valuing the shares to the point where the constant growth is started. So now you can apply constant growth model. So exactly for the point here, you have to apply constant growth model to year 4. You calculate the value of the share to the year 4. Value of the share to the year 4. So you can see the constant growth model. I will go to the slide again. I show you this definition is very important. This one. D1 is dividend payment immediately after the start of the constant growth. Dividend payment immediately after the start of the constant growth. Now we apply the constant growth model here for the year 4. Why year 4? You may look at the question. After year 4, which it will stabilize long run constant growth of 5%. The year 4 can pass harder constant ස්ථාවර අනුපාතයකින් ලාභාංශ වැඩි වෙනවා. Constant growth of dividend. So then you value the shares to here. So then value of the shares for the year 4 is equal yes. So here D4 or D5 now. When you apply the constant growth model, so this is the constant growth model. Constant growth model to the 0 is equal D1 divided by required rate of return minus constant growth rate. Now you apply the constant growth model to the year 4. So then here D4 or D5? D5, right? Dividend payment immediately after the start of the constant growth. So this is D5 divided by required rate of return minus constant growth rate. So then you have to work out D5 here. D5 is equal 11.21 should increase by 5%. Divide by required rate of return is given 12% minus growth rate is 5%. How much the value? Value at the end of year 4. How much the value here? To the end of year 4. Okay then. Maradas? 100. So value at year 4, value of the share at the year 4, 165. 100. 168.14. This is the value of the shares, value of this company share to the end of year 4. Right? Value of this company share to the end of year 4. Now you have identified all expected cash flow, expected dividends, expected value at the end of constant growth period. Now calculate the present value. Now calculate the present value. So you have to discount. This is expected dividend year end of year 1. So you have to discount this to the present. So that is 8.05. You have to discount it for 12% is the discount factor for 1 year. This is 9.26. You have to discount it for 2 years. Dividend expected in year 2, 1.12. Discounted for 2 years. This is the dividend expected year 3, 10.19. Discounted for 3 years. Year 4, you have 2 cash flows, dividend as well as expected price. So consider both. 11.21 is the dividend expected in year 4 and price, so the value of the share to the end of year 4, 168.14. Both you have to discount it back to the present, so you have to discount it for 4 years. So we get the total. So that is the value. That is the intrinsic value. Don't consider maybe 0, right? Because that 7 rupees already paid, right? It is recently paid, just paid. So you do not consider that one. D0 you have to ignore, right? When you are taking, when you are getting the total, don't exclude the D0. What is the value? 130. $135.72. This is the value. 135.72. Right? Now look at this formula. Now you can understand what it says. So value when there is a differential growth rate is equal, you may consider each dividends separately and discount them and get the total. Sigma, you can see D0 into 1 plus growth rate. So likewise for each year dividends you have to identify and discount them and get the total of it. So that is what we do. And also when the constant growth is starting, to that point, value the share. You can see this is the next period dividend discounted divided by R minus growth rate. So that value also you have to discount it back to the percent. So that too is the total is the value. So the same thing we did, right? Don't worry about the formula. Don't worry about the formula. Just ignore this. But you have to know the procedure of doing this. You may better to go with the timeline, identify each dividends, and apply the constant growth model to the correct point. Right? So you have to apply the constant growth model when the constant growth of dividend payment is started point. When the constant growth of dividend is starting. So to that point you have to value the share considering expected dividend. Right. So this is with the differential growth rate. Now I think you have your tutorial examples I prefer to do. You need a break? Normally we are having break at 3:30, no? What's that? It's a 3 o'clock. If you need, you may go and come with the break. Huh? Without having break. Okay. Huh? You have? All right. Okay. Okay, no problem. Why? What is the problem? Huh? Right. Okay. Now look at your tutorial. I will. You may try with the. I don't know why this editing mode I can't remove. There is a problem with this. I try to make this editing mode is on, but anyway, you may look at this section in your tutorial. This one, ABC PLC is considering. You can see, rapidly and expanding rapidly, and currently needs to retain all of its earning for the investment. However, investors expect that ABC will begin paying dividends with the first dividend 2 rupees received in 3 years from today. Dividends should grow rapidly at a rate of 50% per year during years 4 and 5. After year 5, the company should grow at a constant rate of 8% per year. If The required rate of return of the for the company stock is 13%. What is the value of the stock today? So you can see differential growth rates are there, right? This one, right? Question number 5. I think you can see, no? Right. So you can apply the things. Right. Okay. Do this quickly. Right, you can read. This is differential growth rate model. is the answer. That's similar to the previous one, the differential growth rate. Will you get the answer? What is the answer? 47? 50? 57? I think. Similar to the previous one. 57? Huh? Right, anyway, you can check. Should one answer. I don't know whether I have wrong in my answers also. I have received 57. Is it the value here 95? 95? Value at the end of year 5. Because after 5 there is a constant growth. Huh? This one. What is the wrong? 4.77 dividend year 6, is it correct? Right. I have put year 6. Right, 97.2. Then 58. Is it 58? So for the exam, you should be able to do evaluation like this with the differential growth rate. So important point is identifying the year that you should value the share to the point where the constant growth is started. Now in this example, after year 5, from here to onwards, there is a constant growth in dividends. So then you have to value the shares to the year 5. Okay. Do you have any questions, any clarification on this? Last row. හරිද? ඉනහේ ඉන්න හදලා නම් තිබ්බේ නැහැ. හරිද? මොන හරි අහන්න තියෙනවා මොන හරි question එකක් තියෙනවා මොකද දාන්න බෑ I am not doing any more question. Right? How about others? Right. So let's go to the next one. Right. If growth rate is not given, now in this, now here growth rate is given, constant growth rate is not, growth rate was given. But if growth rate was not given, you can calculate growth rate by looking at the accounting data or the annual report data. So growth rate according to this we call retention model. According to this model, you can calculate growth rate using this formula. Growth rate is equal retention ratio into return on retained earnings. Return on retained earnings or return on equity. Because retained earnings mean internal equity. Retained earnings, it belongs to the equity capital. So we consider it as an internal equity. Here, return on equity or return on retained earnings. So growth rate, you can calculate retention ratio into return on equity. Because when you apply the constant growth model, there are assumptions. Earnings growth is constant. Payout policy is constant. Capital gain yield, dividend yield, share price, all are moving to the same rate, same pace. So therefore, you can apply this retention growth model. I will show you how to derive this one. Actually, that part not applicable. But anyway, if you look at this one, it is explaining earnings next year earnings. If there is a constant growth in dividends of a company, next year earnings is equal earnings this year plus retained earnings this year into return on retained earnings. So if I write like this, right, I will go to this slide. Earnings next year, say ET. Earnings next year is equal earnings this year, say E0. This year I am using E0, earnings this year plus retained earnings this year. So retained earnings this year 0 into return on retained earnings, or say return on equity or return on retained earnings. Return on retained earnings or return on equity. So based on this formula, you can forecast earnings next year if there is a constant growth in dividends. Earnings next year is equal earnings this year plus retained earnings this year into return on retained earnings. In this formula, if you divide both sides by earnings this year, right? Both sides you divide by earnings this year. That means E0. This is also we divide by E0. This term also we divide by E0. Normally, you know that any appreciation of any variable, share price, whatever, for any variable, you can calculate P1 minus P0 divide by P0 formula. Here, earnings growth you can calculate. Growth of the earnings is equal ET minus E0 divided by E0. Any variable appreciation or growth, මොකක් හරි ඕනම variable එකක growth එක ඒකේ වර්ධනය අපිට ගන්න පුළුවන් P1 this current minus previous divide by previous. P1 minus P0 divided by P0. Same way, if you need to calculate earnings growth, you can apply this formula. Earnings growth is equal ET minus previous E0 divided by E0. Now this one you can rewrite like this way also, no? ET divided by E0 minus E0 divided by E0. So E0 to E0 there is a trade-off. So it becomes 1. Then if this 1, if you take to the other side, so here it will be 1 plus growth rate is equal ET divided by E0. Right? So then you can here ET divided by E0 in this formula you can substitute by using 1 plus growth rate. So then 1 plus growth rate is equal this one. Now if you look at this one here, this 2, there is again trade-off, so this become 1 plus plus. Then here, this one you can write like this way also. Retained earnings this year divided by earnings this year into return on retained earnings. Now this one to this one cut each. When the one is going to the other side, it become minus. So positive to negative, there is a trade-off. Then you can cut off each. So then it will be growth rate is equal. You can see retained earnings this year divided by earnings this year into return on retained earnings. Now if you consider this, retained earnings this year divided by earnings this year, what is the ratio? Retained earnings this year divided by earnings this year. Earnings this year, retention ratio and payout policy. So retained earnings this year divided by earnings this year is the retention ratio. Retained earnings, retention ratio. Right? So that is retention ratio. So then this formula will become, you can see. Right. This is way of deriving this formula, right? So in this formula then, growth rate is equal retention ratio into return on retained earnings. This is the retention growth model to calculate growth rate. If growth rate is not given, you can apply retention ratio. You can take from the annual report data. Return on retained earnings or the return on equity you can calculate from the past data. So then you can apply retention growth model to calculate the growth rate. Growth rate is equal retention ratio into return on equity. In the steps here, the same thing I explained. It has mentioned in these steps, so you can neglect it. But anyway, this derivation part is not applicable. Growth rate you can calculate retention ratio into return on equity. Right? Return on retained earnings or return on equity. Now let's look at this one. When there is a constant growth in dividend, value you can calculate using constant growth model. According to the constant growth model, next period dividend divided by RICA rate of return minus growth rate. So this constant growth model, this one constant growth model, you can solve, you can simplify for the R. R is our RICA rate of return. So if you simplify or if you solve this formula for R, RICA rate of return is equal next period dividend divided by value plus growth rate. In this formula, so this next period dividend and the value can be calculated easily by looking the market forecast, annual report data. So you can identify that, because with the available public information you can identify, you can forecast next period dividend as well as the market price value. Growth rate you can calculate based on this retention model. Growth rate you can calculate using this retention model. So likewise you can estimate growth rate or RICA rate of return. So then you can apply this growth rate to here to calculate the value. If growth rate is not given, you can use this retention growth model to calculate the growth rate. Now look at this example. CBL PLC's return on equity, ROE, return on equity or return on retained earnings. Equity means external equity, right? Retained earnings is the internal equity, is 12%. And retention ratio of the company is 75%. If company payout policy is expected to remain unchanged, determine the growth of the dividend of the company for the next year. Now the application of this retention growth model. If company payout policy are expected to be constant, you can apply our model, retention growth model, to calculate the next period dividend. Determine the growth of the dividend of the company. So you can apply this formula. Growth of the dividend is equal. Retention ratio is 75%, return on equity is 12%. So return on retention ratio into return on equity. 75 into 12%. Here then. Retention ratio is 75% into 12%. So you will get 9%. That is the growth rate. Growth rate is 9%. Using the retention growth model, you can calculate growth rate if you know company return on equity and the payout or the retention ratio. If you know the payout, you can calculate retention. Now here, retention is 75%. So how much the payout ratio? Retention ratio is 75%. Payout is 25%. Retention 75, payout is 25. Right. If the dividend just paid for the company is 5 rupees and the value of the company share is 40, determine the required rate of return. Company just paid dividend is 5 rupees and the value of the company or the market price, consider both are same value and the market trading price is 40. So what is the required rate of return? So required rate of return you can calculate using the constant growth model and simplifying it to the R. According to this, required rate of return is equal D1 divided by value of flat price plus growth rate. Company just paid dividend 5 rupees. So just paid me D0. So how much the D1? How much the D1? Previously, company growth rate we have calculated. It was 9%. So the D0 is given. So then you can work out D1. Growth rate is 9%. We calculated it. So then D1 is equal 5 should increase by 9%. Divide by value is 40 plus growth rate as we calculated earlier 9%. Right? From earlier we have identified the growth rate here. See 9%. So this now you can apply here to calculate the next period dividend. So then you will get required rate of return is 22.63. 22.63. Right. So likewise, you can use this constant growth model to estimate the required rate of return also by changing these variables. You can apply that way also. Now look at this example. Wind PLC stock currently sell for 20 rupees per share. Stock just paid the dividend 1 rupees per share, and dividend is expected to grow forever at a constant rate of 10% per year. What stock is expected 1 year from now? What is the required rate of return on stock? This is from your tutorial. Now this is the application of the constant growth model. Before going to the other level, I think I have put some question for to discuss. Yes. Yeah. Before going to the price multiples, quickly let's look at this thing. Company shares currently sell for 20. Just paid dividend of 1 rupees. Company just paid the dividend of 1 rupees per share, and dividend expected to grow at a constant rate of 10%. What stock price is expected 1 year from now? What is the required rate of return on the stock? Application of the constant growth model. Do quickly. So here, company shares currently selling for 20 rupees. This is the price. Price at 20. Just paid a dividend of 0. D0, 1 rupees. Dividends is growing at a constant rate of 10%. Constant growth rate of dividend is 10%. What is the stock price is expected 1 year from now? What is the price here? What is the required rate of return? Did you calculate? What is the required rate of return? Huh? How many is it? How many is it? So here you can apply the constant torque model at 0. First we have to identify the required rate of return. Now if you apply the price at 0 or the value at 0 is equal, if you apply the constant torque model at 0, this is the value or price, any is correct. Next period dividend D1 divided by required rate of return minus growth rate, constant growth rate. So P0 price is given 20, D1 you can calculate because constant growth rate is given 10%. If D0 is 1, then D1 next period dividend is equal 1 into 1.1 divided by R is not there. So you have to work out R minus growth rate here 10%. This is 10%. So solve this for the R. Work out the R first. Required rate of return here. So your answer is required rate of return was 15.5. You can solve this and you can check. 15.5 is the R. You can apply the cross multiplication here. 20 into R minus 0.1 equal 1.1. So you can solve this for the R. You will get 15.5. Others, did you get the same 15.5? Yeah, you can simplify for the R, so that is 15.5. So then P1 value or the price in the next 1 year from today. So then you can apply the model, this constant growth model to the next year. So value or the value in next year or the 1 year from now is equal D2 divided by R minus growth rate. So D2 you can calculate because growth rate is given now. How much the D1 was? 1.1. D1 is 1.1. So then D2 you can calculate 1.1 into 1.1. 10%. D1 is 1.1. So this is again should increase by 10%. So 1.1 into 1.1 divided by R is 15.5 minus growth rate is 10. So you can get the value. This is the application of the constant growth one. What was the final value? 22. 22 is the answer. Right. Look at this one. SMB experience in the period of rapid growth, earnings and dividends are expected to grow at a rate of 15% during the next 2 years, at 13% in the third year, and at a constant rate of 6% thereafter. SMB's last dividend was 1.15 rupees and the required rate of return is 12%. Calculate the value of the stock today. Calculate the price in year 1, year 2. Calculate the dividend yield, capital gain yield for year 1 and 2. Actually, these are tutorials, so you should do at home. Huh? Do this one also quickly, you can do. This is also differential growth rate. So first you have to value this stock for the today. Then calculate the value for the next year and the year 2. And identify dividend yield and the capital gain yield. No time for the homework, Nene. So if you draw the timeline here, if you draw a timeline, rapid growth, earnings and dividend are expected to grow at a rate of 15% during the next 2 years. 0, 1, 2. Next 2 years, dividend and earnings and dividends are growing at rapid rate during the next 2 years, so at 15%. So applicable rate is 15%. 13% in the third year. For the year 3, rate is 13%. And at a constant rate of 6% thereafter. For year 4 to here, there is a constant rate of 6%. So these are the information. Last dividend or the just paid is 0 is 1.15. So calculate the value of the stock. I will go to the Excel, that is easy. $1.15. So you can calculate D1, D2. 1.15 should increase by 15%. 1.32. should increase by 13%. Here constant growth model should apply to year 3 or 4. In this, you have to calculate the share value, because after year 3 there is a constant growth in dividends, so constant growth model apply to year 3 or 4. Year 3 or 4? 3 to the end of year 3, because after the year 3 there is a constant growth in dividends, so you have to value the share to the year 3. So you can see value is 15.12. Value at the end of year 3, 15.12. Huh? So now you have to discount these cash flows to the present to calculate the present value. Discount rate is 12%. You can check, right? Might have a mistake by myself also. Any mistake is there? Did you get it, sir? Hello? Value Is it? Huh? Dividend year for 1.82. 1.72. It should increase by 6%. So then dividend in year for 1.82. So then M7 1.82 divided by 12 minus 6%. Make a where is it? Yes. 13.36. Then 25.23. Right. So this is the current price. If you go to the question, calculate the value of the stock today. So today, or the zero value is 25.23. Next, calculate the price or the value P 1 year from today and 2 years from today, P1 and P2. So you may calculate the value for the 1 year from today and the 2 years from today. Now if you calculate the, now this is value at 0. Right? This is value at 0. Now calculate the value for the P1 or the 1 year from today to here. So value is equal for the P1. So if you now this is the timeline 0, 1, 2, 3, 4. So expected dividend we have already calculated now. This is 1.32, 1.52, 1.72 is the price, sorry, dividend, and price is, value is to the end of year 3 is 30.36. So we have to consider both. Now value at year 1. So value at year 1 means you have to consider expected dividend. Now if you are going to purchase this share from here, 1 year from today, if you are purchasing, if you are going to invest at year 1, so what is the value? So value depends on the expected, this, you may expect this dividend, 1.72 dividend in the year 3 and value at the constant period 30.36. So you have discounted this 3 to here. Value at P1 is equal present value of the dividend expected in year 2 1.52. Now value here. So you have to discount this dividend to here. Here dividend and value both. So then you will get 1.52 into 1.112 into the power minus 1. You may discount it back 1 year. Discount. So now here dividend 1.72 plus value 36. Both you have to discount it for 1.12 into the power minus 2. 2 years. Is it 25? So value here plus this 26.93 the value at 1 year from today, or the value at 1. Here, price and both dividends you have to consider. Correct? Right. So then P1 price at year 1 26.93. Then price year 2. Price year 2. So here price year 2 mean to here. Within the price taker for the year 2. Price at year 2 mean present value of the dividend expected in year 3 and the value of the share at the to the point where the constant growth is start. So you have to discount this to here. Value at year 2. The value at year 2 ke 1.72 dividend you have to consider. If I go to the separate line again. So again same timeline. 0, 1, 2, 3, 4. So value at year 2 mean here there is a dividend 1.72 and the value during the constant growth period 30.36. So you have to calculate present value of this dividend 1.72 plus value of the stock to the end of constant growth period 36 discounted for 1 year back for 1 year into the power minus 1. So that is 28.64. 28.64. Now calculate the dividend dividend yield for year 1, capital gain yield for year 1, dividend yield for the year 2, year 3. So likewise, no. Calculate the dividend yield, capital gains yield for year 1 and year 2. For year 1 and year 2. For year 1, dividend yield is equal dividend per share divided by price. Dividend yield is equal year 1 expected dividend is 1.32 divided by price is 26.93 for year 1, right? Capital gain yield is equal 26.93 minus previous price 25.23 divided by 25.23 into 100. Percentage you have to multiply by 100. Dividend yield and the capital gain yield. This is for year 1. So year 2. Dividend yield is equal, year 2 dividend is 1.52 divided by price. Year 2 price is 28.64. Capital gain yield you can calculate based on the 0 price as well as from the P1 price. Here I am calculating based on the P1, right? P1. 28.64. 28.64 minus P1 26.93 divide by 2693. What are the answers? Year 1, dividend yield. Dividend yield is equal dividend yield is equal 1.37 divided by 26 into 100, 5.03. Capital gain yield equal 26 minus 25 divided by 25 into 100. 6.75, right? Then year 2 dividend yield is equal 1.52 divided by price is 28 into 100, 5.30 approximately. Capital gain yield is equal 28 minus 26 divided by 26 into 100. 6.35. If you get the total here, approximately it equal to 12%. 12% approximately, right? It is equal to 12%. So 12% is our required rate of return. Required rate of return includes dividend and capital gain. So you can see here approximately dividend yield and capital gain is equal to 12%. In this section you can see your required rate of return is 12%. This is 12%. I think if you go to the assumption in this constant growth model, expected total return, expected required rate of return, or the return is equal to expected dividend yield and expected growth rate, dividend yield and expected growth in the capital gain. So approximately you can see here it is equal to 12%. So likewise you can calculate price, dividend yield, capital gain yield in the even for the next period you can calculate. Right. So then right. May I discuss this too quickly? Huh? Maybe maximum 5-10 minutes. Huh? Or may I let you to do by yourself? Which one you prefer? If you are committed for yourself, no worries. Let's look at, just read the question. Just read. I will explain the steps. Look at B Mountain PLC, mining company. Reserves are being depleted, so its sales are falling. Also, its pit is getting deeper each year, so its costs are rising. As a result, the company earnings and dividends are declining at the constant rate. Now, the earnings, dividends are declining at a constant rate. There can be a increase in or the growth at a constant rate as well as a declining. Right? Declining at a constant rate of 4% per year. D0 is 5, Required rate of return is 15% for investor. What is the value of B Mountain PLC's compared? Again, this is the application of the constant growth model, but here negative growth. There is a negative growth in dividend. Declining. Other again, other the so there is a constant decline. So same model. So value you can calculate for the B Mountain by applying the constant growth model. According to the constant growth model, value is equal next period dividend divided by R minus constant growth rate. So this is the model. So now here D0 is given. D0 is 5 rupees. Recently paid dividend 5 rupees. So then how much the D1? Next period dividend is how much? D0 1 plus minus growth rate is 4% minus 0. So then D1 is equal how much? Alright, so that is 5 into 1 minus 0.04 means 0.06. Okay? 0.06. So then D1 is how much? Next period dividend. Then there is a decline. Okay, then. 4.8. So next period dividend is 4.8. 4.8 divided by investors required rate of return is 15%. 15% minus 4%. Right? When there is a negative growth, negative or the decline in constant rate of dividend. So here required rate of return minus growth rate normally. So required rate of return minus growth rate. So then minus this will become positive. So then 15 plus this. So you can calculate the value. So what is the value? Here. 25 point something. 25. Right. So anyway, you have to solve this. That is 25. So remember, when there is a negative growth, you have to be considered like this. Right. So this one I will let you to do by yourself at home. If you have any difficulty, I think no difficulty. We have many questions related to this. You may do this one at home. Next day I will start with the price multiples, and also you will have your that's good. And also your presentation also I had a plan. Just quickly I will show you my plan. I don't know whether I can meet it. If you go to this roughly I am planning to have your presentation here March 16. So you will have the next third quiz. Now we did on the time value of money. Up to this point, right? Make a tentative. Right? This is taken because of the some cancellations are happening. So you will have the next quiz up to this point. Bond valuation, security valuation. Right? Bond valuation and security valuation. Excluding the earnings multiple. No earnings multiple. Huh? Amount of 1 month extra So you will get one more. Right? So you will have the next quiz 30 minutes with reflection on one valuation and this security valuation, ordinary share valuation. Alright, term में figure it out. This is my next week for it out there with you. I will inform you. Now I have given you assignments details. I hope that you are working on it, right? Group assignment, I have given all the information, so you may work on it. We'll have a presentation on the 6th that day. Okay, thank you.